Morning, I am Taylor Wesson and I'll be taking you through Naspers' interim results. Please note I will not handle any questions during the webinar, but feel free to ask questions which I will then respond to via email. Here's a quick look at what we will be covering today. We'll start off with the nature of business, followed by the recommendation, the financial review, divisional review, company guidance, and end off with the portfolio guidance. Taking a look at the nature of business. Naspers is a global internet and entertainment group and one of the largest technology investors in the world. The group operates in more than 120 countries and markets. The group's divisions include internet, video entertainment, and media. The internet division is made up of e-commerce and SNS. E-commerce includes classifieds, business to consumer, payments, and Naspers Ventures, which includes ventures in food, while SNS includes a sizable stake in both Tencent and Mail.ru. Now moving on to the recommendation. We feel the share offers value at current levels, despite Tencent's stretched valuation. Tencent was a key contributor to performance and remains the dominant factor for investment return, given its size in the portfolio. Naspers is currently trading at a 26% discount to the value of its listed investments and at a 32% discount to our estimated sum of the parts valuation, which translates into our overweight recommendation. Given the evolving nature of many of the group's businesses, determining sustainable growth accurately remains a challenge, as high growth has already been priced into Tencent and Mail.ru. Forecasting risk thus remains high. The rump, which includes the group's unlisted assets, still trades at a negative value, but offers material upside potential supported by an improving return on invested capital profile and the improving trajectory of these assets. The improved disclosure of the group's unlisted assets, together with their continued market share gains, could support the narrowing of the discount. The group's continued investment in Letgo remains a drag on the profitability of the classified business. Results of Pay TV South Africa improved with solid growth in the subscriber base and better cost controls supporting performance. However, the sub-Saharan business remains under pressure. Emerging market risk aversion and changes in venture capital risk appetite could likely have a material impact on the valuation of investments. Now moving on to the financial review. Naspers delivered positive results for the period ending the 31st of September, supported by growth in the e-commerce business and robust results achieved by Tencent. Group revenue, measured on an economic interest basis, rose by 33% year-on-year, or up by 39% on a normalized basis to 9 billion. When we speak about results on a normalized basis, this is on a constant currency basis and it excludes the impact of disposals and acquisitions. Adjusted operating profit rose by 43% to 429 million, supported by a decline in development spend. The adjusted operating margin improved to 13.8% from the 10.1% in the previous period. Development spend on the consolidated business was down by 18%, thanks to the competitive positions of the early-stage businesses, which required less investment. Excluding the 155 million investment in Showmax and Letgo, development spend on the older assets was down by 12%. Net interest was down by 27%, supported by the lower use of credit facilities and the proceeds from the Allegro disposal. Core headline earnings and core HEPS grew by 65% to 1.5 billion and 350 US cents respectively. No interim dividend was declared. Now moving on to the divisional review. Internet makes up the bulk of the group's revenue. The Internet segment benefited from solid growth by Tencent and classifieds. Revenue grew by 42%, or up 52% on a normalized basis, to 6.9 billion. We'll take a further look at e-commerce, which includes classifieds, B2C, payments and ventures, and then we'll look at S&S, which consists of the group's listed investments in Tencent and Mail.ru. Now moving on to e-commerce. Revenue rose by 15% or up by 38% on a normalized basis, driven by strong performance by payments, classifieds, food delivery and e-tail. E-tail is the largest contributor to e-commerce revenue, contributing 55%, followed by classifieds, which contributed 18%. Trading losses rose by 9% to 318 million, and with equity accounted investments contributing 44% to the loss. However, on a normalized basis, e-commerce losses declined by 17%. The division now includes 20 profitable entities, up from the 19 entities a year ago. Now moving on to classifieds. Excluding the additional investments in Letgo, classifieds turned profitable during the period. Revenue was up by 47% or 38% on a normalized basis. The business now includes 14 profitable entities, up from the 11 a year ago. Overall user engagement continues to gain traction, with monthly active users in apps up by 30% to 85.4 million. The focus for OLX is to continue to expand in monetization markets. Revenue per internet user was up by 34%. OLX Europe benefited from tailwinds in the vertical business, while OLX Brazil is expected to reach break-even by the end of the 2018 financial year. Avito achieved strong growth during the period, with revenue up by 34%, while still maintaining margin of above 60%. The Letgo business in the US continues to gain momentum, with the group still achieving solid growth in mobile monthly average users, despite the recent pullback in marketing costs. Management have highlighted that there is still significant upside potential for the classifieds business. Now moving on to business to consumer. This division continues to improve profitability as it scales. Revenue was up by 16% or 37% on a normalized basis, supported by strong growth in gross merchandise value. Flipkart continued its growth acceleration and further strengthened its market position. During August 2017, the group acquired a controlling stake in Takealot South Africa by increasing its investment by $74 million. Takealot achieved strong results with gross merchandise value growth of 72%, significantly higher from the previous year. Now taking a look at payments. The PayU division continues to scale rapidly and now operates across 17 markets. The number of daily transactions grew by 86% year-on-year. Strong growth was achieved in India, supported by the consolidation with CitrusPay. As part of the group's focus on building its credit business that leverages its payment platform, the group invested $99 million in CreditTech, a credit scoring business. Now taking a look at online food. Naspers has focused on expanding its online food delivery business. The iFood business continues to grow rapidly. During the period, the group reinvested iFood's profits to continue scaling the business. The group entered into a $775 million deal, which is still subject to regulatory approval, to up their stake in Delivery Hero to a 24% ownership on a fully diluted basis. Delivery Hero continues to show strong growth, with revenues up 64% and orders up 48%. Delivery Hero is listed on the Frankfurt Stock Exchange. Naspers' share in Delivery Hero is worth R56.80 on a per-share basis. The group also invested in Swiggy, the largest and fastest-growing food delivery company in India. Now moving on to Tencent and Mail.ru. Tencent is listed on the Hong Kong Stock Exchange. Naspers' share in Tencent is worth around R4,500 on a per-share basis. Tencent delivered solid results, with revenue up 57% year-on-year, driven by the group's growth drivers, which include PC and smartphone games, digital content subscriptions, payment-related services, and online advertising. Non-GAAP operating profit rose by 37%. Margins declined, impacted by changes in the revenue mix to low-margin products, high channel costs for smartphone games, and increased investment in content. Online gaming revenue rose by 36%, supported by strong revenues from higher average revenue per user from key PC games, smartphone game users, and a higher proportion of paying users. In the second quarter of 2017, revenue from smartphone games outweighed the revenue from PC games. PC gaming revenue is expected to decline in the future. Taking a look at Mail.ru. Mail.ru is listed on the London Stock Exchange, and Naspers' share worth of Mail.ru is equivalent to £56.36 per share. Mail.ru experienced strong revenue growth, with revenue up by 33%, underpinned by growth in online gaming revenues and advertising. Now taking a look at video entertainment. This division contributed 15% to total revenue. Revenue was up by 8% or 7% on a normalized basis to $1.8 billion, while trading profit improved by 4%. The group achieved 11% growth in its subscriber base, with most of the growth coming from lower-end subscription tiers, which still offer significant growth opportunities. Despite the tough macroeconomic environment, DStv South Africa delivered stable results with good profits and cash flows. In South Africa, average revenue per user, known as ARPU, remained relatively stable at R347, with solid increases in PVR. PVR penetration is now 20% of the base and has been key in reducing churn. In sub-Saharan Africa, the financials have stabilized as a result of the turnaround strategy implemented. Subscriber growth was strong at 13% year-on-year. ARPU was impacted by forex movements and declined to $24. Management expects this division to turn to profitability, assuming no further currency weakness. Now moving on to media. This division contributed 8% to total group revenue. Media24 achieved satisfactory results despite the structural decline in revenue streams. Revenue is up by 11% or up by 5% on a normalized basis to $315 million, while trading profit increased significantly by 75%. The performance of the division was supported by cost-saving initiatives. The division remains focused on cost containment measures as well as the migration to digital formats. During September, Naspers unbundled Media24's investment in Novus to shareholders. Now moving on to company guidance. The group will remain committed to scaling its e-commerce business to achieve profitability and cash generation. Management will focus on implementing cost control management and on repositioning these businesses to help mitigate the impact of increasing competition. The group will continue to look for opportunities to invest in the next wave of growth. Artificial intelligence and machine learning are key focus areas across all spheres of the business. Management have highlighted that the current business plan is fully funded. Now taking a look at the portfolio guidance. We feel the share offers value and would recommend an overweight position. Given Naspers' 10% cap in the capped Swix index, we recommend a portfolio exposure of up to 14%. Before we end off, please take note of the following disclaimer. Thank you. That concludes my webinar. Should you wish to ask any questions, please type them in the chat box. Should you wish to place a trade, please feel free to contact our trading desk.